Finish. Very good morning, friends. We are going to have the second session of MMPF 002 on the title Capital Investment and Financing Decisions. I'm Aseem Kumar. I'll be just taking you to the next session of this particular course. Friends, on 9th of July, we have covered 2 units, that means 2 chapters of Block 1 on the title Financial Decisions and Overview, and the units were Nature of Long-Term Financial Decisions and Cost of Capital. Today we are going to cover the unit number 3, Capital Structures Decisions of Block 1 on the title Financial Decisions and Overview, and the unit number 4 of Block 2 on the title Investment Decisions Under Certainty, and the name of the unit is Project Planning and Formulation. Friends, we are starting with the unit 3, that means chapter 3 of Block 1, Capital Structure Decisions. You see, when you plan the capital structure, it is one of the most complex areas of financial decision. Why? Because of the interrelationships among components of the capital structure, and also its relationship to risk, return, and value of the firm. See, being a student of finance, the term capital usually denotes the long-term funds of the firm. It consists of debt capital and ownership capital as basic components of the capital structure. See, if we are just going for the definition, the Gustenberg says capital structure refers to the makeup of a firm's capitalization. Makeup of firm's capitalization. In other words, it represents the mix of different sources of long-term funds. The second definition says, which was given by E.F. Brigham, the term as the percentage share of each type of capital used by the firm, debt, preference share, and equity capital. Equity share capital paid up plus retained earnings. If we are just looking at the concept of capital structure according to E.W. Walker, it includes the following. Number one, the proportion of long-term loans. Second, the proportion of equity capital. The third, the proportion of short-term obligations. In general, the expert in finance define the term capital structure to include only long-term debt and total stockholders' investment. Financial structure means the composition of the entire left-hand side, liability side of the balance sheet. Now, this is the another analogy, the capital structure and the financial structure. The financial structure refers to all the financial resources marshaled by the firm. It will include all form of long as well as short-term debts and equity. Practically speaking, there is no difference between the capital structure as defined by the Walker and financial structure. In brief, capital structure is equivalent to proportions of all time of long-term capital, and financial structure is equal to proportion of all times of long-term capital, long-term and short-term capitalization is equal to total long-term capital. Somewhere or yes, you can just say that there is a huge difference. It is according to the sample we have, according to the nomenclature we have, but on an average, the long-term capital is much more than the short-term capitalization we have. Criteria for determining the pattern of capital structure. What is the first principle? The cost principle. According to this principle, ideal pattern of capital structure is one that tends to minimize cost of financing and maximize the value per share. Minimize the cost of financing and maximize the value per share. Cost of capital is subject to interest rate at which payment have to be made to supplier of funds, tax status of such payments. Debt capital is cheaper than equity capital from both the points of view. According to this, the use of debt capital in the financing process is immensely helpful in raising income of the company. Risk principle. Friends, if we are just talking about the risk principle, this principle suggests that such a pattern of capital structure should be designed so that the firm does not run the risk of bringing on a receivership with all its difficulties and losses. See, risk principle places relatively greater reliance on common stock for financing capital requirements of the corporation and forbids, as far as possible, the use of fixed income bearing securities. Next principle is control principle. While designing sound capital structure for the firm and for that matter, choosing different type of securities, finance manager should also keep in mind that controlling position of residual owners remain undisturbed. The use of preferred stock as also bonds offer a means of raising capital without jeoparding control management. Desiring to retain control must raise funds through bonds and preference capital. Next principle is of flexibility principle. According to flexibility principle, the management should strive for such combinations of securities that enable it to maneuver sources of funds in response to major changes in need for funds. Not only several alternatives are open for assembling required funds, but also bargaining position of the corporation is strengthened while dealing with the supplies of funds through bonds. Timing principle is very important. It was always important in financing, more particularly in growing concern. Maneuverability principle is sought to be adhered in choosing the types of funds so as to enable the company to seize market opportunities and minimize cost of raising capital and obtain substantial savings. Important point that is to be kept in mind is to make the public offering of such securities are as greatly in demand. Friends, depending on business cycles, demand of different types of securities oscillates. Equity share during boom is always welcome. Risk and capital structure, a combination or the relation between these two. A firm's capital structure should be developed keeping in view their risk focus because the risk affects the value of the firm. Risk can be considered in two ways. The first one is the capital structure should be consistent with the business risk of the firm. There should be a sort of synchronization of the business risk of the firm and the capital risk structures risk. Second is the capital structure results in certain level of financial risk to the firm. See, the business risk is there. There are many other risks business is facing, but the capital structure is also resulting into some kind of financial risk to the firm. So the business risk is the relationship between the firm sales and its earning before interest and taxes, EBIT. In general, the greater the firm's operating leverage, that is the use of fixed operating cost, the higher is the business risk. In addition to operating leverages, revenue stability and cost stability also affect the business risk of the firm. There are certain theories of capital structure. A firm should try to maintain an optimum capital structure with a view to maintaining the financial stability. The optimum capital structure is obtained when the market value per equity share is the maximum. In order to achieve the goal of identifying an optimum debt equity mix, it is necessary for the finance manager to be familiar with the basic theories underlying the capital structure of corporate enterprises. The first approach is theory is NI approach. The second approach is NOI approach. Third approach is approach, and the fourth approach is traditional approach. There are common assumptions. What are those? Preference share capital is merged with debt. The firm employs only debt and equity capital. There are only two nomenclature, the debt capital and the equity capital. So preference share is merged with the debt. There is no corporate taxes. This is an assumption only. This is an assumption only. EBIT is not expected to grow. It is an assumption that the earning before interest and taxes shall not be growing. It is stagnant. The firm's total financing remain constant. There is a constant financing of the firm. The business risk does not change with the growth of the firm. Again, these are assumptions only, that the business risk does not change with the growth of the firm. This is again, there are permutation combinations for all those assumptions as well. All investors have the same subjective probability distribution of the future expected earning for a given firm. Okay. Again, this is an assumption only. Let us just look at the first theory, the first approach, net income theory. According to this approach, capital structure decision is relevant to the valuation of the firm in as much as change in the pattern of capitalization brings about corresponding change in the overall cost of capital and total value of the firm. This theory, also known as fixed KE theory, was propounded by David Durant. The critical assumption of this theory are, once again, it is a repetition, there are no corporate taxes, the debt content does not change, risk perception of the investors, the cost of debt is less than the cost of equity. This is a new assumption. The theory works like this: as the proportion of cheaper debts in the capital structure increases, the weighted average cost of capital decreases and approaches the cost of debt. This theory recommends 100% debt financing in optimal capital structure. The following are the strengths of NI approach. It tries to explain the effect of borrowing on overall cost of capital. Okay. It explains and emphasizes on favorable financial leverage by having the debts. However, the theory ignores the risk consideration. These are the assumptions. We are ignoring the risk consideration. Equity capitals are the safe investment, whereas debt capital is always having a risk of compulsory payment of the interest in the course of time and having the charge on the capital assets. Net operating income approach, NOI approach, this approach also propounded by Durant is just opposite the net income approach. Net operating income and net income are two different issues because net income is again having certain other incomes also apart from their main business income. According to this approach, overall cost of capital and value of the firm are independent of capital structure decision, and change in the degree of financial leverage does not bring about a change in value of the firm and cost of capital. The approach is based on the following assumptions. The overall cost of capital KO remains constant for all degree of debt, equity mix or leverage. A new assumption. There are no corporate taxes. An old assumption. The market capitalizes the value of the firm as a whole. Again, a new assumption. The advantage of debt is set up exactly by increase in the equity capitalization rate. A new assumption. Modiglian Miller MM theory. The Modigliani Miller approach is similar to the net operating income approach. the earlier one. It supports the NOI approach, providing behavioral justification for the independence of the total valuation and the cost of capital of the firm from its capital structure. In other words, approach maintains that the weighted average cost of capital does not change with the change in the capital structure of the firm. The following are the three basic propositions of approach: the overall cost of capital KO and the value of the firm V are independent of the capital structure. The cost of equity KE is equal to capitalization rate of a pure equity stream plus a premium for the financial risk. The cutoff rate for investment purposes is completely independent of the way in which an investment is financed. The approach is subject to the following assumptions. Capital markets are perfect. A new assumption. All firms within the same class will have the same degree of business risk. Again, an assumption only. Practically, it's different. All investors have the same expectations of a firm net operating income, EBIT. Again, an assumption. The dividend payout ratio is 100%. Again, an assumption. There are no corporate taxes, an old assumption. However, this assumption was removed later. Apart from having all these approaches, we are having the traditional approach. The traditional approach assumes changes in KE at different level of debt equity rate. It is the middle of the two extremes of NI and NOI, net income and net operating income. Beyond a particular point of debt equity mix, KE rises at an increasing rate. There are three stages. Introduction of debt, net income rises, cost of equity capital rises because of risk but less than earning rate, leading to decline in overall cost of capital and increase in market value. Stage 2, further application of debt, cost of equity capital rises, net income, debt cost increases, value same. Stage 3, further application of debt, cost of equity capital is very high, value goes down. So a business may go any one of the stage simultaneously or abruptly to any one of the stage. Factors influencing the pattern of capital structure. Following are the major factors which should be kept in mind while determining the capital structure of a company. The size of business. Smaller firms confront tremendous problems in assembling funds, collecting funds because of their poor creditworthiness. Investors feel loath in investing some kind of risk or hesitation their money in securities of these firms. Lenders prescribe highly restrictive terms in lending. Why? Because the kind of faith, kind of confidence is low. But on the contrary, in the bigger firm, it's not like that because they have already established their credentials. Form of business organization. Control principle should be given higher weightage in private limited companies. where ownership is closely held in a few hands. This may not be so imminent in the case of public limited companies whose shareholders are large in numbers. Nature of enterprise. Friends, business enterprise which have the stability in their earning or which enjoys monopoly regarding their product may go for debentures or preference shares since they will have adequate profits to meet the recurring cost of interest fixed dividend. This is true in case of public utility concerns because of their monopoly and stability. On the other hand, companies which do not have the advantage should rely on equity share capital to a greater extent for raising their funds, the safe most investment. This is particularly true in case of manufacturing enterprises. Stability of earning. With greater stability in sales and earnings, a company can insist on the fixed obligation debt with less risk, but a company with irregular income will not choose to burden itself with fixed charge. Such company should depend upon sale of stock to raise capital. If your earning is high, you can afford to have the payment of fixed nature, that is interest. But if you don't have that earning, it would be wise, not enough to take such risks, to raise such capital where you are having the instability in your investment procedure. Age of company. Younger companies generally find it difficult to raise capital in the initial years. Why? Because of the limitations they have. And because of the greater uncertainty involved in them, and also because they are not known to supplier of funds. But once they just establish their credibility, they get the funds with ease. Next purpose of financing is the factor in case funds are required for some directly productive purposes, the company can afford to raise the funds by issue of debentures. On the other hand, if the funds are required for non-productive purposes, providing more welfare facilities to the employees, the company should raise the funds by issue of equity shares. Market sentiments. Times of boom, investors generally want to have absolute safety. In such cases, it will be appropriate to raise funds by issue of debentures. At other periods, people may be interested in earning high speculative incomes. At such time, it will be appropriate to raise funds by issue of equity shares. Credit standing. Friends, every organization have their credit standing, and according to that, people do invest in their shares or other securities. So company with high credit standing has greater ability to adjust sources of funds upward or downwards in response to major changes in need for funds than one with poor credit standing. In the former case, the management should pay greater attention to maneuverability factor. Another factor is period of finance. The period for which finance is required also affects the determination of capital structure of companies. In case funds are required, say 5 to 10 years, it will be appropriate to raise them by issue of debentures. However, if the funds are required more or less permanently, it will be appropriate to raise them by issue of equity shares. So if it is a short-term project you have, you can raise the debentures. But if it is just coming out to be a longer term, more than 10 years, then it will be appropriate to raise the funds through equity shares. Legal requirements. Companies Act, Banking Company Act, etc. influence the capital structure considerations. The relative weightage assigned to each one of these factors will vary widely from company to company, depending upon the characteristics of the company, the general economic conditions, and the circumstances under which the company is operating. The last factor is tax consideration. The existing taxation provision makes debt more advantageous in relation to stock capital in as much as interest on bonds is a tax deductible expense, whereas dividend is subject to tax. In view of the prevailing corporate tax rates in India, the management would wish to raise degree of financial leverage by placing greater reliance on borrowing. Okay. The tax structure also gives you an opportunity to move on to the debt capital or the equity capital. Relevance of debt equity ratio in public enterprises. Friends, it is generally argued that the practical significance of the debt equity ratio is limited in case of public enterprises in many countries, because most of the loans are derived from the government itself or from public sector financial institutions. The government as the owner as well as the lender has the access of to all the information it needs about the financial health of the enterprises and does not need to refer to any favorable ratio to derive what? To derive confidence before making loans to it. Even when public enterprises are allowed to borrow from private banks or from foreign financial institution, there is a government guarantee in one form or another that the loans will be bear moved and lightened by adoption of an appropriate policy measures. Friends, with that we have completed unit number 3, and unit 3 once completed will be completing the block 1 as well. We are moving on to block 2, investment decision under certainty. We are starting with unit 4, project planning and formulation. The name itself gives you an idea. Effective management of project is the key to the progress of an economy, because development itself is the outcome of a series of successfully managed projects. This is why project management is receiving greater attention in developing country like ours, so as to avoid project schedule slippages and cost overruns A project need to be meticulously planned, effectively implemented, and professionally managed in order to accomplish the objective of time, cost, and performance. This demands fairly good understanding of nature and types of projects, project life cycle, and concept of project management. What is the nature of a project? Let us just understand. The time, the term project has a wider meaning to include a set of activities. For example, construction of a house is a project. It includes many activities like digging of foundation, pits, construction of foundations, construction of walls, construction of roof, fixing of doors and windows, fixing of sanitary fittings, wiring, etc. Further, project is non-routine nature of activities. Project is a non-routine nature of activities. In fact, a project is an organized program of predetermined group of activities that are non-routine in nature and that must be completed within the given time limit. It is a non-routine, non-repetitive, one-off undertaking, normally with discrete time, financial and technical performance goals. The distinguishing feature of the project are purpose. A project is usually a one-time activity with a well-defined set of desired end results. It can be divided into subtasks that must be accomplished in order to achieve the project goals. Life cycle. Once we are having a purpose and the project goals, we have to just look at the life cycle like organic entities from a slow beginning, they progress to a build-up of size, then peak, begin a decline, and finally must be terminated. Also, like other organic entities, they often resist termination because of the process, say progress quotient, continuous quotient. Some projects end by being phased into the normal ongoing operation of the parent organization, meaning thereby initially it started as a project and thereafter it has become a routine activity of the organization. Single entity, a project is one entity and is normally interested in one responsibility center while the participants in the project are many. Interdependencies project often interact with other projects carried out simultaneously by their parent organization, but project always interact with the parent's standard ongoing operations. While the functional department of an organization, marketing, finance, manufacturing, and the like, interact with one another in regular, patterned ways, the pattern of interaction between projects and these departments tend to be changing. Uniqueness. Friends, every project has some elements that are unique. No two construction or R&D projects are precisely alike. Exceptions are there, though it is clear that construction projects are usually more routine than research and development projects. Some degree of customization is a distinct feature of a project. Some degree of customization. Complexity. A rich project represents a complex set of activities pertaining to a diverse areas, technology survey, choice of appropriate technology, procuring the appropriate machinery and equipment, hiring the right kind of people, arranging the financial resources, execution of the project in time by proper scheduling of various activities contribute to the complexity of the project. Teamwork is very essential in all such matters. Successful completion of a project calls for teamwork. The main firm and the project, within the project, and the other project, wherever the combination or the interaction is necessary. The team is constituted of members who are specialists in relevant fields. Risk and uncertainty. Risk and uncertainty are inherent in every project. Our degree of risk and uncertainty will depend on how a project passes through its various life cycle phases. Customer specific. Our project has always to be customer specific. The client's specification are on the top, so as to cater to the needs of customers. As such, the organization should go for projects that are suited to customers. Classification of projects. What kind of projects we can have? It could be according to the activity, it could be according to the location, it could be according to the completion time, it could be according to the ownership. So let us just have a sort of brief of it. Much of what project will compromise and consequently its management depends essentially on the category it belongs to. Projects can be categorized according to the types of activity, location, time, ownership, size, and need. According to the type of activity. Under this category, the projects are classified as industrial or non-industrial projects. Industrial projects are set up for production of some goods. Non-industrial projects comprise healthcare projects, educational projects, irrigation projects, soil conservation projects, highway projects. According to location, location-wise project can be categorized as national and international projects. Friends, national projects are set up in the national boundaries of a country, while international projects are set up by the government of private sector across the globe. According to completion time, projects under this category can be divided into two types: based normal and crash projects. In case of normal projects, there is no time constraint. Crash projects are those which are to be completed within a stipulated time, even at the cost of ending up with a higher project cost, because it is crucial, it is crash. It's crash project. According to ownership, projects under this category can be grouped into public, private, or joint sector projects. Public sector projects are owned by the government. In private sector projects, ownership is in the hands of the project promoters, the investors. Joint sector projects are those in which ownership is shared by the government and private entrepreneurs. According to size, when we talk about according to size, based on size, there may be three categories of projects. For example, small, medium, and large. As per the present guideline of government, project with investment on plant and machinery up to rupees 1 crore are classified as small. And those with investment in plant and machinery above is 100 crores are categorized as large scale projects. Those with investment limit between these groups are medium scale projects. Means from 1 crore onwards to 99.99 crores is a medium scale project, a very, very vast range of medium scale projects. According to need, based on the need of the project for the project can be classified as new balancing, expansion, modernization, replacement, diversification, backward integration, and forward integration projects. Like any life cycle, we have the project also which has got a life cycle. Most projects go through similar stages on the path from origin to completion. How? The project is born, its startup phase, and a manager is selected. The project team and initial sources are assembled. The work program is organized. Once this is done, the work gets underway and momentum quickly builds. Progress is made. This continues until the end of it is in sight. But completing the final task seems to take an inordinate amount of time, partly because there are of a number of parts that must come together, and partly because team members drag their feet for various reasons and avoid the final steps. May or may not happen, but it happens sometimes. Project management defined. Project management is the process of identifying project opportunities, formulating profitable project profiles, procuring funds for project implementation, scheduling of project activities in such a way as to complete the project within the minimum possible time, cost, and monitoring of the project after its implementation. Defining what is to be done and ensuring that it is done and performed as desired within time and cost budgets, fixing for it through a modular work approach, using organizational and extra organizational resources is what project management has to achieve. Planning project work, initial project coordination. It is a crucial that project's objective be clearly tied to the overall vision and mission of the firm. Senior project management should define the firm's intent in undertaking the project, outline the scope of project, and describe the project's desired end results. Without a clear beginning, project planning can easily go astray. It is also vital that a senior manager should call an initial coordinating meeting and shall be present as a visible symbol of top management's commitment to the project. Once we just do the initial project coordination, then we have to integrate the system with the main frame. System integration, sometimes called system engineering, plays a crucial role in the performance aspect of the project. We are using this phrase to include any technical specialist in the science or art of the project who is capable of performing the role of integrating the technical disciplines to achieve the customer's objective. As such, systems integration is concerned with three major objectives. First one is performance. Performance is what system does. It includes system design, reliability, maintainability, and repairability. Obviously, these are not separate, independent elements of the system, but are highly interrelated qualities. Any of these system performance characteristics is subject to over-design as well as under-design, but must fall within the design parameters established by the client. Effectiveness. The objective is to design the individual components of a system to achieve the desired performance in an optimal manner. This is accomplished through the following guidelines. Require no component performance specification unless necessary to meet one or more system requirements. Every component requirement should be traceable to one or more system requirements. Design components to optimize system performance, not the performance of a subsystem. Cost. System integration considers cost to be a design parameter, and cost can be accumulated in several areas. Added design cost may lead to decreased component cost, leaving performance and effectiveness otherwise unchanged. Added design cost may yield decreasing product cost, and the product cost may be trade-off against unit cost for materials. Sorting out of the project. In order to ensure a successful completion of a project, we need to know exactly what is to be done, by whom is to be done, and when is to be done. All activities required to complete the project must be precisely delineated and coordinated. The necessary resources must be available when and where they are needed, and in the correct amounts. Some activities must be done sequentially, but some may be done simultaneously. If a large project is on time and within the cost, a great many things must happen when and how they are supposed to happen. The work break-even structure and linear responsibility chart. In constructing the VBS, the work break structure and linear responsibility chart, it is wise to contact the managers and workers who will be directly responsible for each of the work packages. These projects can develop a hierarchical plan. The hierarchy, sorry, these people can develop a hierarchical plan for the package delegated to them. The work breakdown structure can be used to illustrate how each piece of the project is tied to the whole in terms of performance. Tied to the whole in terms of performance, responsibility, budgeting, and scheduling. The journal steps explain the procedure for designing and using the work breakdown structure as it would be used on a large project. For small or moderate size projects, some of the steps might be skipped, combined, or handled less formally than our explanation indicates, particularly if the project is of a type familiar to the organization. So a small revision of a project planning work. First, we are just having the project coordination. There should be a plan proper, how, when, and what are the things to be done. The desired goals and vision and mission should be there. Thereafter, we have to integrate the system of the firm with that project. Once we are integrating the system, the performance is just coming out to be the system's reflection. It could be designed appropriately so that the reliability and maintainability, once the maintainability and repairability are achieved, once the reliability, maintainability, and repairability are achieved, we have to just look at the effectiveness also of the design so that we can get the performance in an optimal manner. Simultaneously, we have to just talk about the cost as well, because nobody can afford, whether a big or a small project, that they'll be running out of the cost. And then sorting out the project once again, once you are just planned appropriately, the execution is to be done. And finally, the linear responsibility chart, the work breakdown structure, how, when, whose work it would be, it has to be created and formulated in the time limit, and appropriate instructions are to be given to the concerned. Friends, with that, we have completed unit number 4 and the first unit, first chapter of block 2. In the next session, we will be starting from unit number 5 of block 2. Thank you.